Today, I'm going to talk about something just a little bit different than I normally do on the show. Now, many of you that have listened to me know that I worked as a financial advisor for the last 7 years. Now, I've held my Series 7, which allows you basically to trade stocks, bonds, options, all that for clients. My Series 65, which is your fiduciary financial advisor license. Series 63, which is your state exam, and my life and health insurance licenses. I have managed millions of dollars for clients, and I have also sold, countless life insurance policies. Now, a theme that's catching on, and it's nothing that's new, but it is kind of scary to me because there's a lot of people that are buying into this, and it's that infinite banking concept. Now, I have to go ahead and kind of debunk this because I go online and I look it up, or I go on YouTube and look it up, and it's only positive videos. And while it can offer several benefits, it's a very misleading practice that a lot of these insurance agents are doing. On top of that, they're bashing financial advisors and telling you not to listen to your financial advisors right off the bat. If you're going to work with a financial advisor or anyone that's going to be dealing with your money, do due diligence on the person. Here's the number one resource you need to know, and that is brokercheck.com. If they have a securities license, which means that they are allowed to give you investment advice instead of just insurance, go on brokercheck.com. You'll be able to see all the licenses that that person holds, who they have worked for, how long they've done it, if there's any discrepancies against them, all of that. It's very detailed. So if you go in to work with anybody, look them up on brokercheck.com. Someone who is an insurance agent is an insurance agent. They are not a financial advisor, even though they pitch themselves out to be. Now, with that said, let's get into this infinite banking. Here's the sales pitch. I'm going to show you how to be your own bank. Go ahead, buy a whole life insurance policy, which is usually an IUL, even though they'll say it's not. They'll tell you it's not an IUL, but generally it is because that tends to give you the best return when it comes to permanent life insurance. But they'll use terms such as like participating index strategy, or like I saw one today was the max premium indexing. That was the name of the product, right? That was the strategy, or infinite banking strategy. They'll start off by showing you a lump sum amount of like $20,000 or $30,000. And they'll say, imagine if you can take your money, put it into a product, and then take it out tax-free. I was watching a video and the guy's talking about $1 million. If you had $1 million, you could take it and put it into a product, and then 30 days later, you're going to take a loan against your own $1 million tax-free. He said 30 days. Okay, if you are going to do this infinite banking strategy, you are not going to be able to access your money within 30 days, ever. Second of all, you're not becoming your own bank. The idea that you're becoming your own bank is crazy. All you're doing is you're going to make a premium payment to an insurance policy, and you're going to overfund the cost of insurance on the policy. So if a permanent policy, let's use myself, I'm 30 years old, I'm healthy, I'm a male. So based off of your health, all the underwriting that a life insurance company would normally do, you're going to say, okay, for $100,000, your cost of insurance may be, I don't know, $100 a month. I'm just using a number. Well, I want to put in $500 a month into this product. Okay, so I'm going to have two buckets. I'm going to have a life insurance premium bucket, and I'm going to have a cash value bucket. I'm going to pay my $500 premium. $100 of that is going to go towards the life insurance. $400 is going to go to the cash value. That cash value generally is going to track what's called an index. The best one I've seen in these products is tracking the S&P 500. Now, they say there will be no risk associated with it. When they talk about risk in the sense of losing any of your cash value, they're right, because these companies will put what's called a 0% floor on the cash value bucket, which means if it's tracking the S&P 500, if the S&P 500 goes negative 15% for the year, you're just going to earn 0% interest. But you get to keep every $400 amount that went into that cash value bucket every month, right? So throughout the year, would that be $4,800? So that $4,800 that was allocated to that cash value bucket just didn't earn any interest that year. If the S&P does, 5%, you have what is called a participation rate, which the best one, again, I saw was 100% participation rate, and they put a ceiling on it, and that was up to about 12.5%. So if the S&P did 5%, then all of your cash value would earn that 5% for the year. If the S&P did 20%, you would get 100% up to 12.5% and nothing over the top. So you would only earn 12.5% interest, which is great still. It's still outperforming the average market return. So you get 12.5% on your premiums. However, you're still paying that cost of insurance. They'll tell you to do this over other retirement options like the Roth IRA or the 401k because, quote, now, I'm not making this up, they will say, you don't want it in a Roth IRA because when your money sits still, you don't earn any money. The problem is they're not saying that in a Roth IRA, you're also can invest in the S&P 500, the exact same index that the life insurance is tracking, and get all of the returns. Now you get all the negatives, but you're not paying for a cost of insurance. 20% of your premium is not going towards insurance. So the 20% you're paying towards the cost of insurance that's not growing for you is growing for you in the Roth IRA. That's like saying if the two products average 10% over 20 years and you did the same amount of money into one, the Roth IRA is going to outperform the IUL 100% of the time because the IUL of a $500 premium, $400 of it's going to cash value that's actually earning the 10% interest. In the Roth IRA, the $500 is earning 10% interest. It's just simple math, right? They both use compound interest, all that shit that they're going to preach to you. They don't tell you about the other products because they can't sell anything in the other products because they're not investment licensed and they don't even understand what 401ks and Roth IRAs and stuff are. Now, as far as the tax benefits, there are tax benefits when it comes to life insurance. However, if you're going to do one of these examples they give you, like the $20,000 or $30,000 lump sum, and then they'll show you like a $1,500 a month premium that you're going to pay after that, to dump money into these policies and avoid what's called a MEC, a modified endowment contract, which is basically the level that the IRS will stop viewing your policy as a life insurance policy and you lose the tax benefits. So based off of how much life insurance you have is going to set a range of how much you can actually fund. If you're going to put in a $30,000 lump sum, then you have to be within a range, which is a minimum and maximum. The minimum to keep the policy from lapsing. And if anyone sells you a policy that you're trying to build cash value in at the minimum amount, you need to sue them. But the maximum, which is where you actually would want to fund this, if it's $30,000, then your cost of insurance is going to be very high. So let's say 20-30% of that $30,000 is going to pay for insurance. And that's just the first year. After that, if you're going to make a $1,500 a month premium, that's great. What is that? 1,500 times 12 months, you're going to fund that every year, but that $20,000 or $30,000 that you're going to fund as a lump sum, you can't fund $1,500 a month after that. You have to wait a year. Otherwise, you're going to MEC. And if you MEC, you lose all of the tax benefits. They're not telling you that. So you would basically do a one lump sum. That's your 1 year premium. Then after that year, you're going to do $1,500 a month maybe. And they give you another, whatever that turns out to be throughout the year. But again, if you had that kind of money, you're still better off putting it in an account where the majority of that is not paying for insurance. They're also not telling you about the other fees that the insurance company charges. So while you're not losing, you have the 0% floor, they're charging you a crazy amount of other fees that they don't even show you. Now, are you your own bank? No. Because the loan you take out is going to be called an index loan. You're going to have to pay interest on it as you would any other loan. And yes, you can take, let's say you had $500,000 in cash value build up after 20 years. Usually it's going to be at the very minimum 2 years before you can take any money out of the policy at all. Now you're going to have a surrender charge or surrender value. Okay. Your surrender value is not going to be equal to the available cash value until usually about year 15. This is in any illustration that you ever run with any insurance company. So for you to be able to access all of the cash value that you have put in and earned, it's going to be about year 15. You can access cash value before that, just not the entire amount. Now, you can take a loan out and they'll say, okay, if you had $500,000 to access, take a $500,000 loan, let's say. You can go use it for whatever you want. And it is tax-free. They'll say, oh, you don't even have to pay it back. What they're telling you is the policy is going to keep earning interest. And when you take this loan away, you're not reducing your cash value because you're not withdrawing money or taking a loan against the money. But you're not becoming your own bank. You're actually taking a loan from the insurance company. The insurance company is keeping your money you paid in the policy. It is going to keep accruing interest, but you still got to pay 5% on the money that you took out. So if the policy is earning, let's say 6%, which is like a non-guaranteed rate of return that they'll illustrate you, but you're paying a 5-6% index loan, you're only a net positive 1%, which would actually probably cause the policy to lapse because the cost of insurance increases every year with your age. They don't tell you that either. Ideally, the loan will pay itself back, but it's still not guaranteed. You can do the exact same thing with your own money in a savings account, or you can take loans against your investment accounts. Guess what? Same tax benefits. If you had $100,000 in a savings account, you could take a personal loan against that $100,000, no taxes, and you pay it back. And it's basically you're collateralizing your money that you have in that savings account. You're also doing the exact same thing inside of the insurance policy, because at death, whatever you have taken out, the insurance company reduces on the total value that is paid down to your beneficiary. So if you had $500,000 in a policy loan and you didn't pay any of it back, you're going to have $500,000 reduced to the total benefit going to your beneficiary at the time of death, because you basically have collateralized the money that is in the policy. It's not liquid until usually, like I said, years down the road. And there are better alternatives with the money where you can get a lot of the same tax benefits. Life insurance is a great estate planning tool. It's a great way to pass money down tax-free to your beneficiaries. And if you're extremely wealthy, where it kind of comes into play is someone who's going to structure a policy the correct way and very carefully for someone who is a high-earning individual, because a Roth IRA has contribution limitations, but also has income limitations. But if you had a 401k that offers a Roth 401k, you can put in a lot more than a Roth IRA. And the reason why you would actually want to fund it is because if your company offers a match, let's say it's like 100% match up to 4%, you're not going to get that money from the company unless you fund the 401k. And you can still put it into the Roth portion of the 401k, which gives you the same tax-free benefits that they're talking about. You just have to wait until you are retired. Whereas in the IUL, you may be able to take out the money sooner than the retirement age of 59 and a half. But do not be fooled by this infinite banking strategy when they start saying, oh, you're your own bank. You're not, because the money you're pulling out is just a loan from the insurance company. You're literally transferring money from your bank account to the insurance company, and the insurance company is becoming the bank. That's all it is. You're not the bank still. You have no say in how that money's invested. You have no say in when you can pull that money out. And you always risk the fact that the policy could lapse. And what they're going to do is they're going to show you this illustration that looks great, the perfect illustration they could come up with. And then you're going to go and sit down with them. And you're going to say, well, I can't do $1,500 a month, but I could do like $500 a month. It's going to be a completely different situation, completely different illustration. The terms are not going to be near what they're going to tell you. Or you may not even be able to get approved anyway because you're not healthy enough. Or let's say you have some health issue, but the insurance company sees it as something that could be, mortal down the road, and they knock you up a couple classes in health risk, and now the cost of insurance is even more. So they're giving you a general concept, they're not telling you the negatives, and it's really getting a lot of people drawn in, and it's gonna screw them. And I just hate to see it. And I hate when they say, don't listen to your financial advisor. And I'm just like, what? If it's a financial advisor and they have the same license as I do, they're held to a fiduciary standard. They have to do what's in your best interest. So if this product was in the best interest, they would let you know. The thing is that the people that are selling this, they're the ones that aren't held to a fiduciary standard. They're a true salesman. Instead of you paying them for the advice on what's best for you, they get paid a commission on selling the product. So it's truly just in what's their best interest. It's not the best product out there. There is a great time to use it, but it is definitely not a product to sit there and pitch to the mass. Not even close. If you have any questions at all, I know this product like the back of my hand. I can tell you the inner workings, how interest is accredited. Whatever question you have on this, I can answer it for you. By the way, I don't work in the industry anymore. I just resigned because I just got married. I'm going to be back and forth between 2 different countries. So I have no skin in the game at all.